right, well, I'm gonna call this meeting to order. And again, welcome everybody. John, we missed you last night, it was a great dinner. And I'm very, very appreciative because this will be my last, meeting as, I guess, what am I, the chair? What am I? Chair.
Yes.
I'm the chair.
The head honcho.
The head honcho of the, and I mentioned last night, and I'll just briefly say again, how much and how honored I am to get to work with each and every one of you, everything that we've, been able to accomplish together as a team, and it truly has been a team effort. And I dare say, whether you, and I know you will, but Arkansas for many, many years to come will benefit from the commitment that we've made. And I pray that that will continue with the next administration. Don't see any reason why it should not. But anyway, with that being said, so I just need for y'all to take a look at the approval of minutes, and if there is a motion, I'd readily accept it to approve the minutes. Going back across the street, we'll have time to get a shot here. Yeah.
I make a motion to approve.
I have a motion to approve. I have a second. I have a second. Any further discussion? All those in favor say aye. Aye. Thank you. So we move down to the business section. I guess you're the director.
You're just now figuring that out. Yeah, and I want to just kind of piggyback on to what the treasurer's done. So it's been absolutely wonderful working with all of you. So thank you very much. And thank you for making me feel so welcome as the newbie 2.5 years ago. Don't have a lot to go into right now on the director's report, just a few highlights. From the last few months, we did attend and have a booth at the State Employee Benefits Fair that was held at the State Capitol in September, and had a lot of visitors for the 529 on that. And then as well, we had a booth and set up a table at the Arkansas, Chris did, at the Arkansas Early Childhood Association conference that was held across the river at the Wyndham back in October. And then Grant and I attended the 529 conference in Florida in October. So that was, there was a lot of information at that. That was really good. From a marketing perspective, as you can imagine, our focus in November and December is, of course, holiday giving, and end of year tax benefits with the 529, and the treasurer and I had the pleasure of being on Channel 11's the CBS morning show yesterday. So that was fun. We got to kind of have fun with the morning guy there. So that was neat. Any other questions or any questions on marketing or? Okay. You want me to move on to checks and invoices? Those of you who approved and looked over this information have been previously sent the list of checks and invoices, and I want to see if you had any questions, and if not, I will seek a motion to approve.
Motion to approve.
Second? A second. Thank you, Alicia. All right. Moving on.
You didn't officially say.
Oh.
Motion. I mean,
Okay, what motion?
You should have said any further discussion and then all those in favor say.
Okay, any further discussion? All those in favor say aye.
We have a lawyer. Please.
All right, didn't mean to embarrass you. Okay. Moving on the agenda, we have a few letters of engagement that we previously asked John Peace to take a look at them. And John, I'll just kind of hand it over to you to discuss the landmark engagement letter and what they do for us.
All right, Landmark, we got their engagement letter. They conducted an audit of both plans, the direct sold and the advisor sold plan. They conduct the audit in accordance with government auditing standards, which they have for years. And I've reviewed the engagement letter. I think it's in order. The fees for both audits would be $90,000, which is a $3,000 increase from last year, but they've been at $87,000 per year, so I'm not surprised that we got a little bit of an increase. So I think we approved 87 in the budget, so we might need to see if we need to amend the budget. But I recommend that we approve the engagement letter.
Any questions? And there are no changes in terms, I mean, it's the standard.
Substance is the same.
You want to ask?
Well, yeah, I have a motion to approve the signing of the engagement letter. I think we need to take that in the form of a motion. I have one, I have a motion to approve. Have a second. Is there any other questions or further discussion about this? Okay, hearing none, all those in favor say aye. Aye. So thank you for approving that. I too think that that's a fair increase. If you break down all of especially I guess the cost of everything. Next.
And the second engagement letter is with Vines Media. They are the agency, I believe most of you have met them. They handle our digital and traditional marketing and public relations. And we wanted to have, for continuity of marketing, especially during the transition period. So we had asked them to draft a kind of a memorandum of understanding for contract services through the end of June for 23. So that would allow the new administration some time to figure out if they want to retain them or hire elsewhere. But we just wanted to be sure that no matter what, that we had continuity of marketing for the next 6 months. So that's what this letter represents. And saying we had John take a look at it and we made some changes.
You have a comment?
I do not.
Oh, okay. Do you approve?
We approve it.
So again, another motion
Mhm.
To approve the engagement letter with Vines, who, by the way, I feel like has done just a tremendous job for us. I mean, just tremendous. But that's probably shouldn't even say that. I have a motion. I have a second to approve. Second. I have a second to approve. Any further discussion? All those in favor?
I did have a discussion.
Okay, I'm sorry.
Was there any changes in their pricing for the engagement for the proceeding to the next level?
I think it was in line with what our usual fees. I mean, there were,
It was just a continuity of service, not a
Correct.
change in the substantive,
yes.
substantive, whatever that word is.
Yes.
And be mindful too, before we approve this, you know, the new administration is going to reserve to at least try to, if they have some interaction, to get y'all potentially if they want to change something. I mean, we're making decisions right now, but they still are things that if push came to shove that they can change. So, any further discussion? Hearing none, all those approved, all those What am I trying to say now, Fran?
All those in
Favor, yeah. Aye. Thank you. Struggling this morning.
Then the next item on the agenda is a brief presentation that Dave wanted to make regarding a platform
Right.
that
And
the
Chris,
census is entering in.
it's in your deck, the first couple of pages, but Chris is gonna put it on the screen. Are you guys familiar with robo advisors? I mean, you know, it's not where you guys are, but, robo advising is, I guess that's the new thing for folks who are a lot younger than I am. But my son and all his, the folks in his age range, they turn to robo advisors for investment. And Betterment is one of the largest robo advisors out there, but they came to us, asking for a partnership where they would put all our plans on their platform and make it easy to enroll. And one of the things that they also offered was a $9.25 acquisition. So basically, for every new client for Betterment, the state would only pay $9.25. So it seems like the acquisition fee is incredible. These are young account owners. They're going to have a lot of kids. They're going to have a lot of time to save. So we had a brief conversation about this a few months ago, but we certainly strongly encourage you guys to participate in Betterment. The direct plan, and again, this doesn't include the advisor plan. The direct plan will be the featured plan on the Betterment website for Arkansas residents. So if you're logging in from Arkansas, you're going to see the direct plan featured on the website. Any questions? I mean, we can go through this and see more, but I'll show you. Christian, we'll go to the next slide. So they've got 750,000 clients. These are users across their entire base. In Arkansas, there's around 3,000. So we got like 3,000 clients living in Arkansas. So there's 3,000 potential new account owners there. I'm sure there's some overlap already where these folks are already account owners, but for the majority, there's a huge opportunity to grow these. So that's what we think if you want to go to the next slide. We think that that 9.25 is a very, very low cost. We would just be taking out of your marketing budget that we have on record, and certainly think that makes a lot of sense financially. Any questions at all on that?
Yeah, board members, if you have any question, again, I certainly see something that I can support there, but y'all are going to be carrying on, so I want y'all to have a little bit more input if there is any question about what Dave is talking about here.
And Dave, just to clarify, I know when we initially talked, when you brought up that the 925, which is a one-time charge, would be coming out of the marketing. We are not locked into like a 1 year, 5 year, 10 year. So if
One of the questions, it reminds me of one of the questions you had early on, is that, if you decided that you're blowing your budget apart, what's the exit strategy? And it's a 90-day, you tell us, and we'll, 90 days, I would shut off.
okay, so I just wanted you to have an opportunity
Absolutely. Absolutely.
And so these are accounts that start on Betterment and then get referred to the plan.
That's correct. That's correct. Yeah, you're not subsidizing non-Betterment clients. These have to be participants in Betterment who are on the Betterment website. They do a search for 5 to 9 information, and this page will pop up. And if it senses that the IP address is in Arkansas, then they'll be presented the direct plan and have the opportunity to actually enroll. The Betterment will do all the tech work to allow them to enroll from the Betterment website into the plan.
and it's direct only, right?
Direct only.
I will say, if you feel like you feel like you're being put on the spot, things can always, I'll just say for the safety, I mean, it can be tabled, it could be whatever, if you don't feel comfortable with it. I've never known Dave not to, in my 8 years, tremendous leadership, and again, I give, he's not in here, in my opinion, trying to do something that's not for the betterment of the program.
Unintended. No, I don't have a problem with it at all. think that this is just another way to attract clients.
Thank you.
Well, any comments? Any other pushback, any other? Yeah, I can say this much and then I'll get on to the motion, but I will say that from the time we took over 8 years ago, and being a businessman, investing wisely, and spending can certainly help, and it is no question our ROI here has been tremendous. So I'm never unopposed to spending money. I'm a conservative, but I'm never unopposed to spending money where I think it's going to help. So hearing that, I probably shouldn't have said that, but I'd like to get a motion to approve.
So moved.
I have a motion to approve. Do I have a second? Second. I have a second. Any further discussion? All those in favor say aye. Aye. Motion carries. Thank you.
Thank you. All right, appreciate that. Well, that was launching, I think they're gonna go ahead and move forward launching their employees, just their employees for betterment, in the month of December, which are almost there. So that's a soft launch and then fully launch in January. So if you guys are Betterment clients, come January, you'll start seeing the plan being offered as a 5-9 option.
Excellent.
Okay, so let's go on to the rest of the data. So we ended the month of October with just over $500 million. So there's a bit of a recovery in the market. You can see the line is still substantially further than we were from last year, but at least we're trending in the right direction until yesterday. Whatever happened yesterday was whatever bad news came out, but I guess that's all related to China. But we are seeing we're seeing the market come back in the right direction. Not to take any of your comments away. So in 2022 year to date, as of the end of October, we saw 46.78 million in inflows. That is, no shocker, a slight decline from last year's inflows of 2.9%. If you want to go to the next slide on withdrawals is really bizarre. We're within like $100,000 of being the exact same amount of withdrawals that we had in 2021. So pretty amazing. I've never seen that happen before. So when you do the math, the net inflows is 8.13 million. That is a decrease of 1.37 million because of the decrease in inflows. So on the funded account side, we stand at 33,633. You can see these lines have the same gap they've had for years and years and years. It's amazing how consistent the account growth is. And then when you look at funded accounts by residency, we are starting to see that the Arkansas residents are narrowing or I guess increasing the percentage across all the accounts. So almost all your growth is coming from in-state account owners, which is great. I mean, that's a great thing. If we go back, and I've said this a million times, if we go back to 2008, 2009, 75% of the account owners were out of state. You guys have done, that's a serious effort. You can't have made that change. Unbelievable what you guys have been able to accomplish when it comes to serving the residents of the state. Average account funded, the average funded account size is just under $15,000. You can see that is substantially lower than we were a year ago, all because of the market. But when you look at the account balances for the beneficiaries that are getting ready off the college, it's substantially higher than them. So we're approaching basically $25,000 as an average account balance for those folks getting ready to write those checks. And on the advisor plan, I'm certainly done with John. The assets are about $100,000 more, almost exactly, in a direct plan as of the end of October. Across those 15,600 funded accounts with an average account balance of over $36,000. And then on UGIFT and Promise Rewards, Randy mentioned gifting a while ago. I do want to point out that UGIFT has had tremendous success here. On the direct plan, over 10 million, almost 11 million in money coming in from people who are not the account owners. It's amazing that someone can give that kind of money. On the advisor side, over 4 million. If you look at the average gift amount, direct is at 524. The advisor is over $1,000. I don't have any friends like that. And then finally, on the Promise Rewards side, this is the free money that comes in from the Promise service.
And I don't know if anyone has any questions on the promise. It's changed a lot over the years since we launched years and years, 20 years ago. But they're still active and they still make sweeps. And now we're over 2.1 million in free money from the Promise Reward side into the direct plan. Any questions at all? Thank you.
Christie?
Get started. Thanks, everyone. I'm Christy Miller. I lead our state relations team at Vanguard and Education Savings. I'm here on behalf of, I would have been here with Julia Ward, but I'm here on her behalf because she is enjoying some time on the West Coast with her son and daughter holidays. She did send her regrets and gratitude for the opportunity to work with all of you. I echo that. I mentioned this before. We're very thankful for the partnership and work with a fantastic team. We're very grateful, Fran, for you, Grant, Chris. We work together, great partners and great advocates for your plan, which we very much value and appreciate. So thank you for that partnership. And it's been a wonderful 8 years. I think you and I have been here almost about the same time. I'll be 7 years in May. So I came in a little bit after you did. So it's been a very interesting time to be part of the 529 business. And it's been a pleasure working with all of you. So thank you for that. And Julia sends her thanks and regrets that she couldn't be here in person as well.
Got a good product, and what do they, you build it, they will come.
Build the dreams.
It's true. So I just want to quickly hit on two things today. One is the formal annual investment review. So we are your municipal advisor for the glide path in the plan, and want to congratulate the team on a successful transition from age-based portfolios to target enrollment portfolios. The project went flawlessly with very little, I believe, noise from any of the account owners, and Dave can corroborate that. We didn't hear anything.
Yeah,
Which
we
goes a
called
huge
it on
testament
zero.
to the planning and thoughtful communications that went out to folks to explain what was happening. So we're not recommending, spoiler alert, we're not recommending any changes to the glide path for this year, but that doesn't mean that we haven't gone through a thoughtful process. So I'll hit on just a few slides about the investment review with no recommended changes for this year, and then we'll hit a little bit on market outlook. So in the slides, I'm just orienting here, Chris, to your page numbers.
Yeah.
If you could hop to page 4, this just goes through a little bit of an overview of our process. So while we don't make changes every year, we go through a thorough review of our methodology and the inputs that derive the model for the glide path that comes out of it. So we do a deep due diligence once a year. More frequently, if market or economic conditions would warrant it. What we go through our capital markets model and input all of the variables for saving for education. So you're talking somewhere between 18, 24-year time horizon, looking at different risk tolerances. And as we look at the ultimate outcome, which is wealth accumulations, we did not see any changes that needed to be made to drive meaningful change in those investing outcomes, so the amount of money that folks would actually save to pay for school. You can always do tweaks here and there, but what we want to do is, one, be very thoughtful about the cost of any changes that we would recommend, and also they would drive the commensurate change in the savings outcomes, and we did not see any opportunities to make those tweaks for this year. There is some supporting information here on slide 7, just to reinforce for you all, we haven't made any recommended changes. You can see that we've had a thoughtful history of reviewing the glide path and making changes where it makes sense, whether that's adding international bonds, tweaking the allocation ratio between international and US, or it's developing the new target enrollment glide path. So we have a thoughtful history here, but we don't make change for change's sake. But every year we go through and have deliberate analysis and debate around the changes that could be considered. Hopping forward to, let's hit slide 13, please. These are the wealth accumulation outcomes that I mentioned. And this is just one example of how we look at the outcomes. When you think about your prior glide path, which was age-based, most folks use the moderate aggressive glide path. Our target enrollment glide path, if you'll recall, when we talked about this, falls about in the middle of those in terms of the equity and risk profile of those glide paths. So that's, this year, we'll just use that as a basis for comparison. So if you look at, a dollar going in every year through all of our evaluation models, and you look at the results of either the moderate or aggressive tracks or the new target enrollment portfolios, you'll see the commensurate outcomes that come out there, right? If you're more aggressive and you're willing to take more risks, there's a likelihood that you're gonna have more money saved, but you're paying for that in terms of your risk. If it's moderate, you're gonna see slightly lower outcomes because you're taking less risk. And then the target enrollment is right in the middle. So there's gonna be a spectrum of outcomes, which you'll see in those, we call them the whisker charts, in those bands where it could be higher, it could be lower. But you'll see those median results coming out as we would expect them to based on the risk profile of those glide paths. And this is just one of the examples of the outcome metrics that we use when we evaluate what the portfolios will manifest in terms of savings. There's other information here. It reinforces the same points. And since we're not recommending any changes, I'm not going to go through the details, but I'm happy to answer any questions before we hop over to markets. No questions? Grant's going to come in with all the questions.
Are we talking about the recession, recession-proof our portfolio for the protection of our?
Just pick me up for the next part. Okay, so if there's no questions, then we'll switch over to markets. I will start here with the slide, starting on slide 17. This is information as of September 30. So I'm sure y'all won't be surprised that things are changing today. As Dave mentioned, right, we had a nice little run in October, and then you'll see volatility hop in. I'm sure, John, you guys are observing the same thing. So as opposed to kind of going through something that's a little bit dated at this point, I thought I would use our market perspectives update from December, just give you a few talking points to think about the forward look. So one of the things that is in here is that our predictions for a recession have moved from 65% to 90%. And that has now become our base case. So we feel like in the US, a recession will begin in the probably second quarter half of next year. And then in Euro markets, we see it starting a bit sooner, probably fourth quarter this year, and then continuing into next year. Realizing growth in the US, 0.25% to 4.5%. So definitely muted, hence the recession. The interest rates, of course, are a big driver in this. We all saw another change for the Fed recently, and we see more changes coming. So we think going into first quarter, by end of first quarter, maybe early second quarter, another change, pushing the Fed's fund rate 4.5 to 4.75, somewhere in that range, but staying there through the rest of the year. And the goal of that at this point is really to curb employment growth. And that's the dissonance that we're feeling right now, is seeing really tough economy, but jobs aren't being impacted. So we have to start seeing some of that balance come. So hopefully that's what will play out as the Fed takes action, see employment come down, and then start to get inflation under control.
Is Elon Musk helping?
I'm not sure. He's certainly keeping headlines going. When you think about headline risk, I think a lot of things, even with crypto, I think that's probably even the bigger headline right now with FTX. I know I talk about that regularly. My 16-year-old, that's all he wanted for Christmas and his birthday last year. His mom, just buy me ETH. I'm like, no, I'm not buying you ETH. I work at Vanguard. We will have a balanced diversified portfolio for the long term. So needless to say, that conversation has tempered a bit on his part. But this is what we're seeing across the board, right? There are all of these anomalies that are happening, and depending on that news, you're seeing it play out in the market. So as we look at returns, so as you all know, we focus on the long term. We use a 10-year model. I thought I would just share some of the changes that have occurred for our 10-year outlook. When we're looking at 10-year returns, US equities between 4.7 and 6.7%, which, while muted, when we look compared to the last 10 years, is pretty much in line. We usually say, even back to Mr. Vogel, for equities, you should think 6 to 8% return. Not always double-digit returns, right? But they will fluctuate and then smooth out. Over that period, you'll see a value outperforming growth, which growth has really taken a beating recently, and a small cap outperforming large cap. When you look at global, 7.4 to 9.4% returns, seeing developed over emerging markets just slightly in terms of areas of contribution. And then for US bonds, 4 to 5%, global in about the same range, but with emerging market debt really pushing the higher limits of that, maybe 6.4, 7.4. Inflation, right, 2 to 3%. And then I already talked about the recession and the Fed funds rate. So that's a bit of a forward look in terms of where we're at for thinking about the economy. Again, we use a 10-year model purposely. We are focusing on the long term. It's part of our methodology and our discipline. But they have modulated quite considerably over time. The other piece that I wanted to hit on just quickly, and then I'm happy to open it up for questions, is the returns. So the returns for the portfolios are included in your materials as of September 30. We start on 37. Not surprisingly, the short-term returns are a bit painful to look at. They're negative pretty significantly. But again, keeping that long-term look and looking out over 3, 5, 10 years, you're still seeing reasonable positive returns. So you think about the time horizons for savings for college, you're at 18 to 20 years. If you're investing for the long term, you're eking out what would be expected in terms of a long-term return. It is a bit painful for folks that are writing checks for college right now. That said, if they didn't have the exposure to equity and bonds over the last 10 years, they wouldn't have amassed the wealth they actually have available to them to pay. And I think that's why we're not seeing as much concern from account owners. We hear it here and there, no doubt, folks calling in if you're writing checks and feeling a bit of concern around the drops in their account values. But we usually can have really reasonable conversations with folks and say, hey, how are you doing with your risk tolerance? Have you been in the right investment? Were you taking too much risk for your appetite? And that's what you're feeling right now. Or, hey, this got you to this point over the last 10 or so years. You've accumulated this balance. It wouldn't have looked that significant had you had a more conservative investment. You probably wouldn't have even been keeping up with college inflation. So really trying to educate folks around, hey, how do you think about your asset allocation? But overall, I don't know, Dave, if you're experiencing very low phone volumes with concerns about folks, at least at Vanguard, in terms of their balances.
Nothing unusual.
And then, of course, through the next section, you'll see the new portfolios. Because they are so new, they don't have the extensive track record. But you can start to see, right, there's some small losses experiencing now, not surprisingly where the market had been for through the end of the third quarter. I will stop there. If there's any questions or anything else that you'd like me to hit on, so.
What's that max fund rate projection?
Which one? No. Which
You don't mind, right? Let's go. What's the Fed rate that we live by?
Oh, the Fed fund rate?
Yeah.
Yeah, so Fed funds rate projection is landing between 4.5 to 4.75.
Getting close.
Yep. And then we're anticipating that to hold. Now, that said, everything comes with a caveat. 40% likelihood that we get a little more movement there than we're anticipating.
Any questions?
Yeah, I mean, my opening remarks, I would just say that echoing what Christy said, first of all, it's just been an absolute pleasure and privilege to work with the whole entire team during your tenure. There have been a lot of changes that have been positive, especially for Arkansas residents during this time period. First of which I'd like to mention, obviously, the in-state tax benefit for investing in the plan was absolutely tremendous and a contributor to growth, but also just the reboot of the advisor plan during the past 8 years, where we launched broker-dealer share classes. and essentially double the assets within the plan, more than double the assets if you look at the where we were prior to those broker dealer share classes being launched to 700 million at the peak at the end of last year, right before the market correction. So in that sense, it's been, your term has been a tremendous success for both the advisor sold plan, but mainly for financial advisors and their clients in the state that are looking to plan for their children's college savings future. So again, tremendous credit to you and your team. And from my perspective, it's been just great, working with all of you. So I look forward to continuing that in some cases, but wish you the best in your next role for the state and your public service that you continue to do inside the state. So
I'm sure we'll, the team knows we expect and demand results, so it's going to be in some form or fashion. So if I'm looking you up, trying to find some unclaimed property that's yours or whatever the case is, we'll be working in that role. Grant wasn't here, but again, John, thank you for those kind of words. There's no I, and as a politician, it's always, I did this, I did that, I did this. And it kind of goes against my private sector from running my own company. It's the I part. I'm just, hopefully not too much of a negative part of the team. Each of you brought so much to the table, and so that success. So it's been a part of all of us. So.
absolutely. So why don't we start off, Chris, with the global outlook piece? And so I'm not going to cover everything that's in this deck because Christy touched on a lot of it, but maybe I will pull up a couple of things. So if you turn to slide 4, everybody's asking what are the reasons for higher inflation, and a lot of it has to do with production constraints, right? So U.S. labor participation, if you look at the chart on the left, is still way down from the start of the COVID shock, and you can see it compared to some of the other shocks that we've had to the markets in previous years. And at the end of the day, that's one of the reasons why inflation is still persistent, because if you use car production as an example, right? I personally was in the market for a car for the past year, and it's become increasingly hard just to find inventory of cars just because there's not as much production as there used to be. Dave mentioned what's happening in China, so that flows into the production of everything. The fact that you don't have a lot of people that left the labor force prior to the pandemic shock and still haven't returned, that's also leading to production constraints. I think everybody's heard anecdotally about the fact that they can't get people to work in restaurants or construction companies or whatever, and that's causing a huge amount of backlog, and obviously that's causing just persistent price inflation. If you look at slide 5, the pink line here is the pre-COVID trend in GDP growth that we were seeing prior to the pandemic shock, and then the orange line is what has actually occurred. And what we're seeing here is that in order to pull inflation down, we're going to need to have a pretty big drop and potentially a painful drop as far as the recession is concerned to put a lid on inflation. And the best anecdote I've heard in terms of why that's important is that if you have persistent inflation, it hurts everybody, regardless of whether you have a job or not, because it's cutting into your purchasing power, and everybody sees it every single day. Thanksgiving is a great example. People were talking about how expensive turkeys were, et cetera. And if you have a recession, sure, some people are going to lose jobs. It's going to be painful for some people, but those people that are affected are more limited than those if there's just runaway inflation for all of society, right? So that's why it's incredibly important, and the Fed has set it as a priority to try to put a stop onto inflation. I will jump to slide 11, and something that maybe hasn't been spoken about as much in the headlines in the US anyway, is that you can see the difference between US inflation on the left and the Euro inflation on the right. The US has had some advantages in that there are, because of the war in Ukraine, some major, global food shortages occurring. Like the US obviously has a lot of food production. We have a lot of energy production. And on top of that, the dollar is a safe haven for risk, right? So the dollar has been appreciating, and that's been hurting a lot of other countries. So you can see the steepness in inflation on the right versus the chart on the left. The rest of the world is actually seeing much, much worse inflation than we are. I think you might have seen the headline this week that oil prices are basically where they were at the beginning of the year now. So although oil has gone up, a lot, it's basically gone down a lot as well. And for the US, Dave and I were just talking about how much it costs to fill up your car. The levels that we're seeing now are similar to where we were seeing them toward the beginning of the year, right? So although we've been talking about inflation a lot in the US, it's actually much, much worse for the rest of the world. So just some of the things that we're talking about, it's going to be tough to land in the right spot in terms of Fed hikes, where it doesn't drive the US and the global economy into too deep a recession. But you need to slow down that runaway inflation that we're seeing right now. And that has to be a priority for everybody, which is why the Fed's in this rate hiking cycle, and the rest of the central banks in the world as well will be there. But it's a necessary evil to try to tamp that down. So that's it as far as market commentary is concerned. Dave mentioned the growth of the plan. There has been, as you can see, roughly $100 million correction due to market volatility over the past year. It's a 13.5% decrease since the end of the year last year. We'll see what happens in the next couple of months. And if you flip to the last slide in terms of what's happening in Arkansas, the good news though is that the number of financial advisors in the state continues to increase. The number of accounts within the state continues to increase. And that just speaks to the fact that there's increased utilization within the state. People are becoming more and more aware of the plan, which is great. All those firm advisor totals in bold on the right side, these are all firms that have added advisors that are selling the plan just since the last board meeting, right? So all of these are growing. As we can see, there's 443 financial advisors, 8% year-over-year increase. So even though you've had this drop in the financial markets, it hasn't stopped. And Dave's slides speak to the same thing. It hasn't stopped the account growth. It hasn't stopped the utilization. So the importance of saving is still in the minds of Arkansas residents and people generally, even if they can't save as much, right? And so that's the most important thing. Markets are going to go up, markets are going to go down, but you want that saving behavior to be increasing, and that's what's occurring. So that's it for my remarks.
Thank you, John. So from one John to another.
Yes, the budget report. This is for the period that begins in fiscal year July the 1st through yesterday, November the 28th. The expenses are totally in line with budget. Income is down, which is understandable because our admin fees are based on a percentage of the account size. So the account size is down, so income down. This doesn't include one item of income that we're expecting in November, and that's the Vanguard fee, and we're just checking on that. It didn't appear in the bank statement, so you can expect another $28,000 or so coming in from Vanguard. For the year, the net loss or expenses over income is a little over $47,000. We're going to end the month, the Southern Bancorp ending balance $168,772, and First Security $34,279 for a total of $203,051. But we can expect that other $28,000 coming in from Vanguards. That's my report. Did you bring it with?
I requested approval, I was denied. I have my briefcase ready, but it was a no-go.
Just put it in the vault.
Thank you, John, for that. So, is there any other new business? Anything that, I guess?
Yes.
Yeah, no, we're good. Well, then I guess with much, sadness, I want to ask for a motion to adjourn. So moved, yeah, we're in good shape. Well, again, thank y'all so much.